Hello, everyone. Welcome back to another episode of Navvai Shift, the podcast where we sit down with leaders reshaping finance, technology, and growth. So today we're joined by Keith Friedman, CEO of FBO Strategies. Keith has built a firm that stands out in wealth management for its tailored asset allocation strategies and deep trust and trust-based client relationships. With his background spanning portfolio construction, risk management, and decades of guiding clients through complex markets. Keith, how you doing?
I'm well, and yourself?
Very, very well. It's a pleasure to have you on our show today.
Thank you for having me, Zamari. And Darnell. Darnell, I hope I pronounced that properly as
You
well.
You did.
Great.
Thank you very much.
I should have asked in advance because, sometimes not everybody gets it right.
Yeah, I've had a couple crazy variations, honestly, but Keith, spot on.
Yeah,
So just so you know, if you ever get a chance, there's a famous comedy duo in the United States named Key and Peele, where one of them plays a substitute teacher in, and he goes in and tries to pronounce everybody's name. And it's really funny. I encourage you all to watch it. And my son's name is actually Aaron, and he says A, which is Aaron, and he calls him Aaron. So we call my son Aaron sometimes.
Keith, I think I definitely need to watch it because
it's hysterical. There's actually two of them, and there's a commercial for Paramount Plus that he does it away, like where he calls Bluey the blue animated dog Baloo,
Is he doing this on purpose? Is he like mispronouncing it on purpose?
Yes, he's doing it. Well, he's not doing it on purpose. I mean, the skit is on purpose, but he's not doing it on purpose. He's playing a character who, is trying to figure it out. It's very funny.
Okay.
It's one of our favorite family comedy skits.
I was a little bit concerned for a second.
But yeah, Keith, so for everyone listening, can you give us a bit more information about yourself, the FBO strategy, and how it kind of came about?
Sure. I've been in the financial services industry for 21 years as an advisor. I started my own firm back in 2011. So believe it or not, that's 14 years now. That's shocking to me to hear. So in that time, I found that there were an enormous amounts of conflicts of interest in the industry, and I didn't figure out how to eliminate them. But I figured out how to deliver the best solutions to my clients and mitigate those conflicts of interest. One way we do that is the easiest way. We just disclose them. We're 100% transparent about them. So our clients know exactly how and how much we're compensated when we're working with them. And that way they can decide if we're providing value to them or not.
Yeah,
I also felt that the industry did not do a good job of providing a holistic view to clients about what the world provides and what the advisors are doing. So my big contention is, in the United States, the wealth management world has come down to this thing that we call the fiduciary standard. That standard has been translated into only being compensated for a fee for assets under management. But A, that does create its own conflict, so we can go into that later. But B, that doesn't mean that those are the things that are going to get the best results for our clients. And that's where we come in. We have figured out a way in certain asset classes, not all. We work in a very narrow field of the wealth management world in terms of the way we provide value to provide better returns for our clients. But we are not compensated by fee of assets under management. We're compensated through a commission. But once again, we disclose that to our clients. And we're also independent. We're not tied. It is using insurance products. We're not tied to any one insurance company. Our clients have almost the full breadth of the industry available to them, with a few minor exceptions.
No, that's amazing. I really appreciate that insight, Keith. And I think even from the first kind of conversation, you've kind of made it very clear to me that you've definitely prioritized your clients. And I think you kind of emphasize long-term relationships as well, and that's also built on trust and transparency. So I kind of want to get a bit more insight. What does that actually look like in practice in the day-to-day?
So it's something that's very easy to say and much more difficult to implement. So our clients, it's very easy to say to them, hey, we have your best interest at heart and you can just trust us. But we're given very few opportunities to actually prove it. And we relish them. And that is always giving our clients the best advice, no matter how much money we are going to make. So the best example I have of that, we had a client who worked at a large financial institution in New York City, and he came to us for a very specific need. Now, I happen to know that that financial institution offered their employees a benefit that was truly better than anything I could give him. And I advised him to take that benefit. And from that day forward, I won that client's business. Now, I've never made a lot of money off that client, but A, he's a friend, and B, he tells everybody that story. And him telling that story has the most value to me. That's the best advertising I can get. And in my world, I actually can't offer a different product than anybody else. We position it in a different way and we construct it in a different way, but I can't offer a different product than anyone. So the only things I can offer are my values, my analysis, and the way we put it together. So it is hard to set yourself apart with that paradigm in front of you. And the best thing I have is my reputation. That people know that they come to me, I will tell them the truth. And I work hard to do that every day. I am sure I don't get it right 100% of the time, but we work to, and we are also very fond of saying we don't know, but we'll find the answer. And that's the other thing that clients can come to us, is that if it's past our level of expertise, we will certainly refer them to someone else or find the answer for them.
I just want to say I feel like that's something so simple, yet so many companies don't do it. But I did want to ask you, so because you have that analogy where obviously you support your clients, you just tell them the truth no matter what. How do you then service clients that are just not happy with the truth? Do you just kind of tell them it is what it is, or is that of interest?
So my wife will frequently say the phrase, Keith, stop being so logical. I don't know how to be any other way. So there are clients who don't want to work with us because this is the truth, as partially as we view it and as we can prove it. And if clients don't buy into that, because a lot of the media and other financial advisors are adamantly against everything that we do, that's a hard thing. So we have to overcome that. And frequently we will say to a client, like, we're not a good fit. Like, we had a potential client come to us last week, and I said to the individuals, like, I'm not 100% we're a good fit for you. You're listening to this other person over there, and I'm sure that person is a good person. All right. But we have a completely different approach. And I'm happy to share with you why our approach is better, but you have to take the time to intellectually dissect it to realize that what we're saying is true. And that's hard for people when the media and other professionals are telling you the opposite. So we don't jive with everybody. Clients don't always like to hear the truth, and that is a tough thing, and we deal with sometimes very wealthy people or people who make a lot of money, which they think makes them smart. And one thing I learned in my career was that I am certainly not the smartest person in the room, but I am an expert in a very small area. And I will do that every day. And when someone comes to me and goes, well, my best friend says this, I was like, well, what do they do for a living? Oh, they're a doctor. Well, that makes them smart. And I'm going to go to them with my headache or my stomach ache. But I do this every day. I look at the numbers. We do analysis all the time. We have research projects that we work on. This is what I do every day. And if you want to go take your doctor's advice on your personal financial planning, that seems a little mismatched.
I mean, when you put it like that, it's very clear to see. But so just on the subject of just on the topic of clients, so Keith, I want to know if your client expectation has really evolved since you started, and how have you actually adapted to those changes in terms of like the way you've kind of changed your models as well as communication?
I don't know if we've changed our communication at all. Our communication is pretty straightforward. Clients hear from us at least once a year, just as like you have an annual review. If you want to take it, here are the numbers, blah, blah, blah. Or they definitely get birthday cards, or they should get birthday cards. And it's actually just a handwritten note that says happy birthday. It's not anything fancy. And then we, as a firm, are fairly social. So we like to go out and see people. We host a couple of events every year. My favorite is called Dorkfest, and we haven't done it in a long time. And what Dorkfest is that we rent out a movie theater the opening night of any new Star Wars movie, and we go see the movie opening night. And as I mentioned to you earlier, my other favorite event of the year is that I told you I'm very tall. I am still a huge basketball fan. We go to a bar every year and watch the Final Four, which is a big American sports event for basketball. And we have a great time. We watch both games. We eat a lot, drink a little. Maybe some people drink a lot and eat a little. but it's a great time. And I love being social with my clients. And many of them are within my social circles, which actually makes it very enjoyable. I like when people I know ask me for help. It makes me feel good that I can actually help them.
And I think for them, it's very clear for them that you are the go-to person in this space, because as you said, you're highly skilled within this specific field. So it kind of makes logical sense for you to be the person to go to, for sure.
And it's interesting in this day and age of technology, our advantage is not that. Our advantage is actually the human touch, is that we want to be personable with our clients. Our clients are not, it's Darnell, going back to your question, is like, we want long-term relationships with our clients. We do not want transactional relationships. I've now been in business for 21 years, and many of my clients are now coming to us for the second and third time, which is wonderful for me in my business. And that doesn't happen without me building that relationship over the years, and sending those like happy birthday cards, which are kind of silly, but once again, everybody gets email. Very few people get letters in the mail. So we are actually literally building a new system so those get automated a little more, and I'm not always rushing to send them out, which would be nice.
No, that's amazing. I think the stuff for those touches that used to be a common thing 20 years ago are now becoming back in flow now, back in fashion for sure, because technology, people kind of want to avoid that now, kind of have that human touch element. So it's definitely still vital for sure.
Yeah.
Yeah, I kind of wanted to ask, kind of as FBO has grown, has it been getting harder to maintain real-time responsiveness and transparency, especially as kind of client data or touch points multiply over time?
No, our responsiveness probably gets better. I mean, our focus is much more on the insurance side of the industry. And insurance companies are slower than the asset management world in terms of the technology they provide and the access we have. But technology is always improving, and we are always getting more and more. So I can now go in on a daily basis and get client information, where when I first started in the industry 21 years ago, that was not always the case. So it has gotten better, but also the things that we do are very slow moving. Typically, updates only need to happen once a year. So we don't need instant access to every minute detail all the time, like you do with an investable portfolio. We can track what we do, throughout the year, but the update is really at the end of the year, so we don't have the always on time, information constantly. It's a lot less noisy.
Yeah, it definitely makes a lot more sense for sure. And I think you've definitely set the why and definitely the client's ethos. So I'd love to kind of unpack the engine in regards to your allocation philosophy. So it's a carbon allocation. I know that's your signature. Yeah. So in plain English, what is it and why did the market need it?
Sure. So most financial advisory is based on the theory of modern portfolio theory, which is actually not modern at all. It was actually written in the 1950s. And since the 1950s, the markets have changed drastically. The biggest change we see is the speed at which the market exists. So volatility and swings are much bigger. When I was first coming out of college 30 years, 100-point movement in the markets was just gigantic. And now that's an everyday thing. Not every day, but it happens a lot. So the market's changed, and that has a bigger impact as things move more and faster on individual clients' portfolios. So we spent a lot of time. I am not in the asset management business. I don't manage any money. So we focus on insurance, but I used to be in the asset management business. I gave up my securities license because I noticed that, especially in 2008 when the world melted, it was my clients' insurance products that stood tall. Damara, we think we lost your picture. I hope you're still there. There we go. So it was my clients' insurance products that stood tall. And my clients who had insurance, meaning permanent cash value life insurance and or annuities, were in a much better position than my clients that didn't, because they had a safety net that did not move when the markets tanked 40%. And people say, oh, you can use bonds, you can use this thing. Well, I would encourage everyone to look at what happened to bonds in 2022 when the value dropped 20%. Cash value life insurance doesn't do that. Now, we're talking about specific types of cash value life insurance. We're talking about whole life in the United States and index universal life in the United States. There are other products out there called variable universal life and private placement universal life. Those products are tied to the markets. We don't deal with them. Okay? There's nothing wrong with them. It's just that it's not our specialty. And if our clients need that, we will refer them to somebody else. Actually, which happened this week. A client came to us and they were interested in one of those strategies, and I'm just not qualified to help my clients with that. So what we did is we spent time after 2008, years trying to convince clients, you should add permanent life insurance or cash value life insurance to your allocation. But it didn't always jive with people. They didn't really get it. And then about 2 years ago, I was asked by another firm to prove the efficacy of life insurance. So I took out a pad and paper and I wrote down what permanent life insurance actually is and how it behaves. And it behaves just like a conservative asset, except better. But the risk of it is like a conservative asset. So when we now compare cash value life insurance in terms of the ones that we work with to conservative assets, we far outperform it. So the carbine allocation just takes our clients' conservative assets and their conservative assets only and moves them over to a cash value life insurance policy and or an annuity. And by doing that, I am able to give my clients a better return, lower their taxes, lower their volatility, add a death benefit, God forbid something happens to them, and actually in this country, add long-term care insurance protection, which is a huge thing, which if you break that out into different components, meaning a conservative asset plus the death benefit plus the long-term care insurance, you're never going to compete with the returns that I can provide to my clients. And that is the whole game. And we now say, like, our pile of money doing it our way is just going to be bigger than your pile of money doing it your way. And it's that simple. And we've built a tool to show our clients how this works, which is great. If anybody wants to see it, please reach out to me. I'm happy to show it to you. We do keep it behind a paywall. Not a paywall. We do keep it behind a password so that not everybody's using it without our knowledge. And our clients who are financially savvy are the ones who are most drawn to it because they understand the math. And it's our clients who are less, I don't have another way to say it, but less financially savvy, who get stuck in the things that the media and other advisors say about it, instead of truly diving in and understanding it.
So Keith, do you think the reason why the kind of sentiment that people are just not really interested in the asset is because, like you said, it's just because of a lack of education, or is it just because, as you said, their friend might say to them, oh yeah, bonds, the bond market's doing really well, you should mess with bonds, da 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 da.
Well, I think it's a little bit of that. And I also think it's that there's a whole industry who's invested in you not doing it. You know, if you go to the wealth management industry and they're compensated by their assets under management, and you take some of those assets under management, put them into something else that they're not compensated on, and the value of their business is not valued at, it's a conflict of interest. So therefore, I am trying to overcome that. But I will tell you, those who think about this from a purely analytical point of view, I win every day. If you just look at the numbers and take the time to understand how the products actually work, and don't get me wrong, there are many people on my side of the industry, meaning the insurance side, who have improperly used insurance products for the sole goal of making money and not taking care of their clients. And that is a huge problem. We feel we've built a way to do it so that the clients come out better. And that's actually it. We actually make less money the way we do it. And then if we were going to design it a different way, when we design a product, when we design it, it's actually designed so our compensation is little as possible. And some people have come to us, why don't you use products that have a fee on it? Because then it would fit into the model that, the rest of the wealth manager works on it. And the problem is right now in the industry, those products are inferior. So why would I put my clients in a product that is inferior for them just because I'm compensated in a way that fits the industry better? So I think that it's a large hill to climb. We hope to get over it, and we hope this gets more widely adopted. We are trying to work and are working with other firms to adopt it. It's not just us. So we want other firms to use the carbine allocation. Carbine itself is a microscopically thin, man-made substance that is 1,000 times stronger than diamonds. So we use that as a metaphor for putting a thin, hard surface around our clients' assets and making them stronger. And in reality, that's what we do, because I remember during every financial meltdown, we can go back to 2020 with COVID, the markets tanked. Now, yes, they recovered rather quickly, but if you needed money at that moment, your kid went off to college, or you started retirement, or you were about to buy a house, that became a problem for you.
Would have been screwed.
Right. My clients had access to liquid cash to use as they saw fit. Now, we had 2 clients who used some of the money to buy the dip. We did not advise on that. They are sophisticated investors and they had access to cash and they did it. We don't tell our clients to do that, but we showed them where they had liquidity. Instead of their, for lack of a better phrase, their S&P index fund, which was down 30 or 40%. So
Keith,
we provide... I'm sorry, Damari.
Oh, no, so I was going to ask, so in terms of carbine, when it's there in a volatile, uncertain market, how does it kind of behave? What's the difference about it between that construction and risk logic?
So what's great is, the great thing about our strategy, you only have 2 options of what happens every year to its value. It either goes up in value or it stays flat. That's it. It does not go down. So that it's an annual realized gain. So the way the products accomplish this is that they cap your upside. Let's just say the upside is capped at 9%. All right. And it's normally linked to a financial index. We typically use the S&P 500. So the products will give you the participation in the index up to a certain amount. Let's just say, again, 9%. However, if the index goes down, you just get a 0. So now there are expenses, and the way we compensate for the expenses that are built into the policy is that the products also have what are called fixed accounts that are, paying rates similar to CDs or things like that. We'll allocate some money to the fixed account. So clients are always getting money coming in to cover the expenses of the policy. And because of our design, we're actually trying to keep the expenses of the policy as low as possible.
Good. I think, Keith, I just want to go back to something that you mentioned earlier. Obviously, you mentioned that your clients did have cash during the financial crisis in 2008.
Yes.
So I think my question to you is that I know we spoke previously about, obviously, people are kind of against it because that's like the market has pictured against insurance. So I do want to ask, because I feel like that is just an obvious statement that everybody knows, that the financial crisis happened. So it's just
Right.
like, how are you then still reluctant to doing something where you had been much more better off in such a terrible time?
It's called the wealth effect, actually. So when stock prices are up, people think they're richer than they actually are. And in doing that, people don't want to take money out of the stock market to do that. They don't want to take money from anything. They want to put everything in. They want to buy more. And it drives up prices. It drives up the market even more. And that's okay. But we're in the insurance business here. And we want to protect your portfolio as much as we want to protect anything else. So it tends to be the more sophisticated investor who understands that, who understands that maybe they have to take some winnings off the table to protect it. And it is a high hurdle. But once again, people are getting financial advice from their doctor. They're getting it from their best friend who might be wealthy. And they don't do what I do every day. They don't understand it. And, when the world melts, it causes such, not just financial hardship, it causes emotional hardship. And people don't see that. And the COVID recession was very brief. And so people don't really remember 2008. And they don't remember 2001 either. Right? So we haven't had an event like that in a long time. So 2008 was 17 years ago, if I'm correct. I'm good at math. I can't always do math in my head, guys. Give me a spreadsheet, give me a piece of paper, I'm solid, but I can't always do it in my head. So they forget that institutional memory of what it was like, and people who lost their homes, and all of these other people who lost their jobs, and all these other things. So it's hard to remember that. And the truth of the matter is, motherhood is actually like that. Women have a hard time remembering the pain of childbirth because biologically speaking, they want to reproduce. So the pain of childbirth actually gets wiped from the memory. I don't know if you guys have kids, but I have two. And, my wife will remember giving birth, but she doesn't remember the pain of it. So, we are very much the same way, is that we don't remember the pain of 2008. We haven't had it again. And I will tell you, 2009 for my business was actually very good because people are like, oh my God, the world melted and I need to do something about it. But since then, the markets have been on a traditional upward trajectory, except for that one brief moment in 2020. 2022, they were down a little bit. We did see down markets, but, but the other thing I want to say that, Darnell and Damari, is that the other reason we do carbine, and we talked about this at the start, was how the markets have changed. Typically, what happened in asset allocation, going back to that modern portfolio theory, is that you wanted assets that behave differently. And it used to be, it was stocks versus bonds. But if you look at 2022, they both did not do well. So those traditional correlations where stocks would do well and bonds didn't, and vice versa, doesn't really exist anymore. So that's another reason why our strategy works really well, because it limits that correlation between the downward trends in the markets, it's so powerful. And I wish I could wave a magic wand and get people to understand that, but it's hard. And also the other hurdle we have is in what we do, people have to do a little more work to put a policy or put the strategy into effect. It's not just like signing paperwork with opening a brokerage account. They have to sometimes be physically examined. They have to get an opinion from a life insurance carrier, which sometimes might be emotionally hard, especially if they think their health isn't good. So it's not like just signing paperwork. You got to do some stuff. And, it's a barrier to entry. But if you're willing to do the little bit of extra work, the benefits are huge. We've calculated it that we could probably deliver, historically speaking, we can deliver about 250 extra basis points on an effective rate of return, meaning if you factor in taxes. So 250 basis points, 2.5% over a long time is a lot of money. So,
especially once it compounds
right,
well.
Right, and exactly. That 2.5% over 30 years compounded is actually a very large pile of money.
100%. See, Keith, I'm analytical like you. I see it.
That's great.
I do want to ask you about interest. So, do you think there's going to be like a crash? Could you see a crash happening soon?
I can always see a crash happening. Partially because of the way the markets work now is there's so much algorithmic trading that the wrong thing can set off the markets. And I'm no expert in the markets at all, but I always think we are 1 minute away from another huge downward trend. So, and I always say, insurance is based on actuarial science, all right? Actuarial science is the world of large numbers. There's always a probability that it's going to happen. And I don't know what's going to set it off. So I'll give you an example on the homeowner side, even though it's not directly related. My house was destroyed during Hurricane Sandy. The probability of that happening was actually minute. And the day before it happened, I never would have thought it would happen. The morning it happened, I wouldn't have thought it happened. But a giant tree in my backyard cut my house in half. Everyone was fine, and we have good insurance because I'm in the insurance business, and we got our house fixed, and we got it fixed relatively quickly. We rebuilt almost our whole house, and we're back in it in 9 months, which is really, really fast. All right, between planning and approvals and all that stuff. I don't know when the next financial crisis is coming. I have no idea. I see that there is tremendous inflationary pressure in the U.S. economy, which concerns me. I am not a fan of tariffs. I am much more a free trade guy. That's not a political statement. That's an economic statement. Right. I think taking huge amounts of people out of our labor force is inflationary. I do think immigration is a problem, but there's different ways to fix it. But taking huge amounts of people out of our labor force is just going to drive up the cost of labor. And that is of a huge concern. And I am sure Chairman Powell is watching this far more than I am, right? And he is on top of it because it's his job to watch inflation in the economy. And I listen to his words a lot, but I cannot predict when it's going to happen. I will tell you this, my clients who have executed the strategy with us will be in a far better position when it does, because this asset for them will not go down in value, period. So,
So Keith, what metrics or milestones tell you that carbine is doing its job?
so we have an historical experience. We've been at this for 21 years. So, and we've lived through a couple of crises in that time. Also, we've combined a couple of pieces of our research to study that. So one is Mass Mutual actually did a study on the performance of the indexes over the time based in the products that we use. And it's a 6.67, I think. I'd have to look it up and get it to you, but it's somewhere right around that. Performance over time. We actually don't promise our clients that much. We actually lower it a little bit. And that's over a 40-year period. And they show the standard deviation at 4.44%, which is really low. So the margin of error is pretty low. We also use a tool that some colleagues of mine created called Lumen, which can stress test products using, I always mess up this word, but stochastic or something like that testing. I always mess up that word. I cannot pronounce it. But what they do is they basically run a Monte Carlo simulator on these policies to show historically over, thousands of simulations of how markets work, how these policies will perform and have performed. So that's an outside tool that we use. And it's really helpful because we can say with significant confidence that we are going to be successful. It's very nice to say to a client, like, this asset that you have last year, it did 9%. When your money market account did 4.5%, and you didn't pay taxes here because life insurance enjoys special tax provisions in the US tax code. Or I say to my clients, the market's tanked 20% and bonds tanked 20%. Your strategy just stayed flat. And those are great stories to tell the clients, and I get to tell them consistently. And that's a nice thing to do. People frequently come and go, I can manage the money better than the insurance company. First of all, you can't. Life insurance companies are some of the best asset managers in the world, especially on the fixed income and conservative asset side. So you can't. Now, you might be able to achieve better returns in the equity markets, but you're taking a different risk profile when you do that. We are not talking about replacing that. We don't say to our clients, you have $1 million and 750 is in equities. We say, keep that in equities. The 250 that you have allocated to these other conservative assets, or make up the percentages as you want, we're going to provide you better returns there. And that's the crux of what we do. And we had a meeting yesterday with a company that specializes in retirement planning. And so all the things that he was saying, when you accumulate assets, yes, me providing the extra return helps, but your sequence of returns on your assets doesn't matter that much when you get to the end. All right. But when you're taking money out of your assets, it matters a lot. And that's where insurance products, because of those annual realized gains that we provided to our clients, and the assets do not go down in value, are tremendously valuable to clients. Because if you're, once again, sending your kid to college, starting retirement, wanting to buy a house, that money is there for you, no matter what. Now, there is some systemic risk. The insurance company can go out of business. No major life insurance company in this country has gone out of business. And the truth of the matter is, just like the US government bailed out banks, there are mechanisms in place to keep the guarantees, not all of the contracts, but the guaranteed portion of a life insurance contract in force. Okay. There are a couple of cases where there were some, not with our clients. We have strict standards as to what type of carriers we work with. Okay. And we take into account their financial strength. We actually take into account their ownership structure, because I'm going to bash. I'm not a fan of American public companies, because if you have to reward shareholders, you're not going to be rewarding policyholders. And also, some insurance companies have been bought by private equity, and it's the same thing. We don't use those carriers because we don't want them reporting their their investors versus their policyholders. So I don't know how it is in England, but in the United States, we have an ownership structure called mutuality, where the company is owned by the policyholders, We like that ownership structure because you are the owner of the company. There's one carrier that we know of that's kind of like an ESOP where the employees own the company. We like that as well. There's a couple of carriers that are public companies, but they're foreign owned. One's a UK, oh, sorry, not UK. One's a Canadian company, one's a German company. And they have much more control over, there's not as much pressure on them to deliver results to shareholders the way a public American company is. So we are conscious of that for our clients. So we've never had a carrier that we've worked with and placed our clients with that has gone out of business or anything like that. We've had carriers change their business, which has been a little bit of a problem, which is why we've become more concerned with the type of carriers we're using. Like many other things in life, you get what you pay for. So if you do something that's inexpensive, it's inexpensive for a reason. So sometimes sometimes what we do for our clients does involve simple, what's called term life insurance protection to make sure they have enough death benefit to someone if something happens to them. And when we do that, sometimes we'll encourage our clients to pay more money for a policy that has better features or the carrier is better. And we've proven over time that that's become important. And if they want to use a carrier that just because of the cost, we might encourage them to do it through someone else because we don't want to be caught with a problem. Like we actually have a client like that now. He only has his term insurance and he had a heart attack recently. So he can't get new life insurance. And I don't know what to do for him right now. We're still working on it.
Keith, you're an analytical man. I have faith in you. You'll figure it out.
I hope so. Considering he's a friend and I've known him for, oh my God, there's a 3 in that number. There's a 3 to start that number. So that's a long time. So, and I know his family. And so I hope to figure it out. But, it's, although Darnell, you actually just gave me an idea.
See, look at that.
I don't know if it'll work, but it's definitely
Fingers crossed.
Keith, within our team, we always say we can't dwell on the problems, just got to find solutions.
Yeah. And tomorrow, I feel the same way, is that you can come to me with your problems, but I'm going to give you solutions. I don't do well when people just complain about their problems. I do that in my life here. Like, I'm part of an organization here, and as I mentioned, I played basketball, and the basketball court was in bad shape, and I went to the CEO of the organization. I said, this is a problem, but I want to fix it. So we went out and we raised money to redo the basketball court now, which was great, and I'm very proud of that. I play on that court almost every week, but I'm not someone who wants to sit around and just complain about it. I want to help fix things. And it's one reason why I've taken on Carbine as not just for my firm FBO, but I do want to push it out to the industry. I want it to become much more an industry standard. Now, that's a big hill to climb, but it does deliver better results for the clients, and that's what we should be about.
Yeah, no, 100%, I agree with you for sure. So Keith, I kind of have to ask, if you had to drop one beloved traditional allocation rule to improve outcomes, what would you cut and why?
Damar, I'm not exactly sure of the question.
So say if you had to drop one beloved traditional allocation rule that a lot of people still use to this day, but you think if you could drop it, it would improve the outcome potentially, what would you cut?
Sure, that's easy. It's the correlation between stocks and bonds. People believe that if you have stocks and bonds, you're diversified because they believe that the correlation isn't there, and it is, and we can see it. That the movement of the stock market moves the bond markets. And I don't know if that's actually true or it's the reverse, because I am not embedded well enough, in that. We did see when the tariffs were originally going to come in the United States in the spring that the bond markets really flattened the stock markets. Now, they recovered after the tariffs were reduced, but, I don't always know which one moves which, but they move together now. And the axiom of diversification through owning those two types of assets is not true anymore. Where if you can execute our strategy, we are giving you uncorrelated or lower correlated assets.
So Keith, out of interest, because obviously, as I think, hopefully Damari's told you, but obviously we are an AI company. So does AI play a role in what you do day to day?
Not yet. We've looked at a lot of AI platforms. On the P&C side, property and casualty insurance, AI seems to be having a bigger role that in terms of analyzing claims and monitoring weather and stuff like that. But every AI platform we've looked at for life insurance is nowhere near up to snuff. I'm not saying it's not going to happen. And I think what will happen is that it'll come in much more on the lower end of the marketplace, where transactions are easier, and it'll happen to reduce friction and lower costs. If a carrier can reduce their underwriting costs, they'll either be more profitable or lower costs to policyholders. So they both can be good things. The big risk a life insurance carrier has is underwriting someone healthy who's not.
Yeah.
So right now, the platforms that read medical records, they're pretty good at summarizing them. They're not great at making decisions on them. Like there's a couple of platforms out there. There's one that does an amazing job of summarizing medical records. We love it. But in terms of interpreting them for a carrier, they do a terrible, the services out there do a terrible job, because AI, for the most part, in my world right now, is still large language models. And if they see a word, they're not always able to put that word into context. So they'll see that word and make a decision on that word. So I'm not a tech guy, and I certainly think AI is coming. I just don't know where it is. We've also seen a tokenization platform, which is interesting, to create, actually, I should say a blockchain platform to track life insurance policies, which I think is interesting. We would like to see more things like that so clients can have better information about their policies. I think that should exist on titles for your house, let alone, a life insurance policy. It's useful for any asset that you can own. So I'm excited to see where it comes. Like, we get calls all the time for like lead generation based on AI, and we don't do any lead generation work at all. So I always say to people is, if you could really deliver clients, you wouldn't be selling them to me. You would be taking them yourself and creating clients. So this whole concept of lead generation makes no sense in my world whatsoever. Because acquiring a client is very profitable for me. So if you could really acquire the client, why don't you set up your own insurance agency, your own wealth management firm, and just do it? The fact that you're selling it to me tells me that they're not good leads.
I guess they're just not professionals like you, Keith.
Yeah, I just don't know how to do it. We've never been successful at mass marketing or anything like that. We are much better at building relationships. And I think there is a place for AI. Like, I've started to understand some of this agent-based stuff in AI. Like, to automate that stuff inside my business, that will be useful. Like sending out birthday cards, Now, they don't have to send it for me, but they could create the workflow. Now, this is just automation. It's not necessarily straight AI, but just create the workflow, and just so you know, we are finally launching our first CRM. The CRM world in life insurance has been sad, to say the least. So we hired someone to actually build us a CRM. And it's relatively basic. It's actually not that hard. It wasn't a huge undertaking. But I think that, saying to an AI engine, get the policy information for this client, that will be tremendously useful. Instead of calling a call center, like, that's brutal. Like even as an advisor, calling a call center for client information is brutal. Or change this address, or any of these other minute things that we have to do for clients. To be able to just tell a system to do it for us, that will be very useful. I don't see it impacting planning anytime in the near future. It's just, there's too much nuance to what we do. Like if you wanted to partner with like one carrier and get something done, that's fine, and that might work, but that's not going to work when you're really trying to do what's best for clients, because you need the full breadth of product out there to find the best solution for clients. And that's really hard to do with AI, because first of all, the carriers are not giving away their information. They're just not. So I don't know where it's going to go. We do watch it all the time, and anytime we see a story, there is a company that we've looked into on the annuity side that does some stuff about projecting the values in annuities that we like. Is that really AI? I don't know. And they market themselves as AI, but is it just running a financial model? Like,
Essentially, I feel
right?
like AI is just a buzzword.
Right. Like, if you go to their website, it says, "Oh, we're an AI solution." I was like, I'm not sure you're an AI. I'm not saying you're not a good solution. You are a good solution, but are you really AI? Like,
Tech solution.
and to me, AI is like the greatest search engine ever. Like, I could do so many
Without a doubt.
things that way. I will help it. This is what I love about AI. So we subscribe to a lot of research. All right. And we send that research to clients. And we can't understand some of the research because it's written on a very academic level. But we will tell our clients, drop the PDF into ChatGPT or to Copilot or to Claude and let it summarize it for you.
Or explain it for dummies.
Right.
That's what I
Right.
say.
Right. And that is the most wonderful application. And sometimes what we'll do is we'll include the ChatGPT summary. It's like ChatGPT said this about this. And to us, that's great. That has been wonderful for us because like I said, I'm a dork and I like to read the research, even though sometimes I don't understand it because it's written above my head. But I want to know what academics are saying about the industry and what's going on. McKinsey puts out a report every year that touches on life insurance. EY just put out a very interesting piece about almost exactly what we do. That was, it's hard to understand the piece. Like if you're not going to spend your time reading it, but you drop that into ChatGPT, it's great. It gives you the best summary.
You bullet points and you have
Right.
a clear insight.
I mean, if you do that, it'll basically say Keith is right. You take that EY piece and it'll tell you Keith is right. It's wonderful.
Keith is bang on the money.
ChatGPT is on my side, so I think that like the world is my oyster. But no, we do strive to prove it to clients every day that what we're doing is the right thing. And Darnell, going back to your point, not every client buys into it, and I can't convince them. They're stuck. They're stuck in views that existed for a long time about these products and not understanding how to use them in a modern sense. I guess it's a good way to put it. Everybody has their prejudices about their experiences. And the bad side of the life insurance industry is that life insurance professionals have done a bad job in many cases. Because it's a business where the compensation can be big, and people, Warren Buffett always says, tell me how someone's compensated, I'll tell you how they behave. And when you do that, it's hard when you're a firm to say, we are going to make less money per client to do the right thing. Now, we don't do this altruistically. We believe that will deliver more clients in the long run to us. But, I don't know how to really do it any other way. Like, it's, proving your moral center is hard, but we want to do it every day. And the people who work here know that. So once again, it's something that's easy to say and hard to prove.
Yeah, no, definitely. But I think the main thing is kind of having alignment amongst the team and everyone's on the same kind of trajectory and everyone kind of understands what the purpose is for. And I think that definitely speaks volumes in that sense. Keith, before we wrap up, I wanted to just touch on looking ahead opportunities. So if you replay this conversation in 3 years, what would make you say we nailed it?
So I would love to see other firms adopt our approach. That's the biggest thing. It could start off small, but I would like it to become a widely accepted strategy for clients, because I know that'll do great things for clients. They'll be better protected in down markets. They'll be better protected if something happens, and also get more yield. So that's like in 5 years, I would love to have 100 firms doing this. That would be an amazing feat. I can't project revenue. I can't, because I just don't know yet. We're relatively new to systematizing this and branding it and putting it out there to others. Like we always inherently did this ourselves at this firm, but to go the next step to go out to the industry and say, this is the way the industry actually really should function. Also, I would love to see movement on the fiduciary standard by the government, in that this is providing better results for clients. It's lowering risk for clients. Those are all good things. And it should be incorporated into the way the fiduciary standard is interpreted. And if I could see those two things, that would be a huge win for me. Just huge. And if, someone could build an AI system for me to do this without actually having to think about it, it'd be great. But,
maybe we'll jump on a secondary call for that, Keith.
It's just, I think in today's day and age, the carriers are the big block on that. Because, getting...
Yeah, that makes sense.
Right. Getting inside the carriers to get what we need from them is what the problem is.
Yeah, no, of course. Keith, this has definitely been a fantastic discussion. I know we covered the founding vision behind FBO strategies and how carbine allocations can help navigate complex markets for sure. So last but not least, what is one practical step wealth firms could take this quarter to improve their client outcomes and transparency within 6 months?
It's actually pretty simple. They can look at their book of business, and for every asset that, for us, it happens over a 1 to 7 year period because of the way money goes into a life insurance policy, but to look at their book of business and say, all right, we have X dollars under management, all right? And Y dollars are in fixed income or money market accounts or CDs, or insert the name of conservative asset here. We are going to move that and show our clients how they can get better returns by using a properly constructed cash value life insurance policy. It's not easy, but it's simple, because there's a lot of steps and you have to convince clients to do it, but clients will be better off. And you as an advisor can sleep better at night. And we're happy to teach anybody how to do this. It's not rocket science. We don't push any rules or laws or regulations. We are all within, everything that we do is well within the scope of what the law says, what tax code says, what the industry says. We're not pushing any of that. We're just taking what we do and applying it to traditional wealth management. And I
think you need to become a thought leader, Keith. I feel like there's a lot of people missing out on this information.
I am working on it. Our white paper should hopefully be published in the next 4 weeks. Okay. So once that's up, I'll be happy to send it to you. We did just create a presentation about a modern portfolio theory in the 21st century. We have a few more calculations to do in it. I am not brilliant at how to do some of these calculations. And there's also debate on how to do some of these calculations, which I didn't realize. Because when we looked at, this is interesting, like when we looked at calculating alpha, which in the investment world is extra return, which we can deliver. Well, alpha is just calculated on raw numbers. But because we're a tax-deferred, potentially tax-free strategy, and a traditional money market account or CD isn't, how do you factor that into the number? And it's really hard. And there's debate about, none of the information actually talks about how to adjust for that, which is really, and we are having an internal conversation about how to present that issue. Because we want to be respectful of what the math shows, but there's this glaring thing, like if you're in a 30% tax bracket, we are 30% more effective. So that's significant. If you're 40% tax bracket, it's a 40% more effective. If you live in New York City, it's a 50% more effective rate, So, but people put money in money market accounts all the time, and I don't get it.
Yeah, so I think it's just based on kind of what they know, though, isn't it?
Right.
I think it's about getting knowledge out there and what other options are actually there. So Keith, for those who want to learn more about you and or FBO Strategies, where is the best place to connect?
So people can call my mobile phone. It's 212-380-8676. Please don't spam me. It is my mobile phone, and it rings next to my bed at night. Or my email address is keith.friedman@fbostrategies.com, and our website is www, which you don't need anymore, but I grew up in an age where you did, fbostrategies.com. We're on LinkedIn. I am not on TikTok. I am not on Instagram. That's not us. We take what we do very seriously. We are not a sales organization. We want to be, Darnell, to your point, we want to be the thought leader in this area. We're driving to that, and we don't feel, nothing against Instagram and TikTok, but we don't feel that's where thought leadership really happens.
Keith, okay. I thought I saw you doing TikTok dances for one time.
Oh,
Pretty sure I saw that.
Darnell, you definitely, first of all, you don't want to see me dance, period. Okay. You know, I am a card carrying member of the Rhythmless Nation. You know, it's embarrassing. I've been asked not to dance in certain places and certainly not sing. Not sing everywhere. Nobody ever wants to hear me sing.
So just only in the shower and that's it.
All right, in the car by myself is all I get. Like,
Okay.
if I have any family member in the car, I better be like just mumbling it along with the song.
Can
Like, my
imagine
wife
when
and I
Keith-
just watched the Billy Joel documentary. I don't know if you have it in the UK yet, but like, I grew up on Billy Joel. He's you know, one of my favorite songwriters, and like, I'm sitting there singing. Every time I do, my wife looks at me and was like, "Oh God,
It looks like
you're
you're
ruining the
disgust.
song for me."
I can imagine Keith in the car by himself, really singing his heart out and with all the vocals.
Well, it gets a little worse. Is like, I won't really even do it with the windows open, okay? Because I don't want other people to hear it.
There's no, not
People
taking any
chatting like,
chances.
thinking, what is going on here?
Oh, easy to find. You know, or you know, you can always look at us. We strive to respond to anybody who reaches out to us the same business day, and we're happy to talk to anybody. Like, we want to be a little bit of evangelists about this. You know, we think that this is a better. I've said this about 100 times in this call. We think this is a better in this podcast. Is that this is a better solution? It gets everybody in a better situation. And now there are limits on this that, you know, this doesn't work when you get above, I don't know, age 60 to 65. And there are other things that we do for that crowd, but it's a little different. But, you know, this does not work. But if you're age 30 to 60, it's great.
Yeah.
You know,
No, that's-
so if anybody has any questions, we are an open book at how we do this and our analysis, and we want to share it. You know, whether you're another wealth management firm, an insurance specialist, or you're a client who's just interested. We work all across the United States, and, you know, and just to give a plug for the foreigners out there, and I just mean foreigners as not Americans, life insurance has some special status for foreigners in the United States. So there are actually incentives for wealthy foreign nationals to purchase life insurance in the United States, and our strategy fits well into that. So believe it or not, the United States is a tax haven for the rest of the world because the United States tends to not report back to other countries as well. Now, this doesn't work for every country, but countries like the UK and, you know, most industrialized nations, it's great. But you have to have some sort of nexus to the United States. You have to have investments or own a piece of property or something. You can't just show up and do the life insurance. You know, maybe your kid goes to college here. I don't know. You own an apartment in New York City. You know, could be anything. So
perfect. No, I think even Darnell has plans to move to the States, so I think he's got to make sure he keeps
Really?
Yeah, I'm going to Texas.
Texas, where in Texas,
But,
Darnell?
Either I haven't decided fully yet, but it's between Houston and Austin.
Okay. They're actually not that far. They're not that far from each other. You know.
Yeah. So I think I
am
was
the
going to
only.
spend time in both.
I'm the only person who went to Austin was like, it's okay.
Mhm.
Everyone else loves Austin.
Why didn't you like it though? Why didn't you like it?
Well, unfortunately, every time I've been there, which is like three times, the weather has not been good, which is really weird. Okay, so that was the first. That was the first thing, and the second thing, I am once again, because of my terrible singing voice and lack of rhythm, I am actually not that into music, and they have a wonderful music scene. So, you know, and once again, I mentioned I'm very tall. So sitting in a club or something and listening to a concert is not my idea of comfort. So like all these things kind of wrap together. And I also stayed in downtown Austin, and I'm used to New York. When you step out the door in New York City, there's people everywhere. Austin became very quiet, very, very quiet early in the morning and late at night. And I understand most cities are actually that way, but I'm so used to New York that
just people 24/7.
right. So it just, I don't know. It's not that I thought it was bad. It certainly wasn't bad. It was just not like people
Not
go
great.
to Austin and they just love it.
Not great.
They just
not great.
they just love that place. And I'm like, it's okay. It's nice. You know, one of my favorite lines from a movie is not thrilling, but nice.
Hopefully Darnell has a different perspective. We'll
Yeah,
definitely
so
see him in
I'll
his
email you and
cowboy
let you know.
boots.
That'd be great. I was actually supposed to go to Houston for work last week, but it got canceled. So I heard I was lucky it got canceled because it was like 99 degrees and 100% humidity.
Oh,
And I
wow.
haven't seen that since I lived in Hong Kong when I was in college. That was
That's a bit
brutal.
aggressive. That's a
Yeah,
bit
it's
aggressive.
bad.
But that's the wrap of Navvai Shift. I guess, Keith, we thank you for your time again.
Thank you, Darnell, Damari. I really appreciate it. Thanks so much.
Likewise, all the best.
Take care, guys.